So the JSE is not looking healthy. Companies are dropping the JSE like a dead fly. And there's this year alone, it's been a 40% increase in net selling of equities compared to the same period last year. And on top of that, you've got the top 40 companies representing 80% of total market capitalization on the JSE. So not a healthy looking space at the moment. I'm joined now by Theo Vorster from Galileo Capital. Thank you for joining me on Reset the Frame. Theo, how much of this dropping of equity on the JSE is being driven by South Africa's risk premium, or is this a trend that we are seeing playing out in other emerging markets as well?
Hello, Ilse Marie. Thank you for having me. Look, I do think it is concerning from a JSE's point of view. What we have seen is a lot of capital uh, moving towards the big first world countries, the big markets. And even if you look at that, if you take the S&P 500, which is the benchmark market in the US, you can actually say there's a S&P 7 and a S&P 293. Almost the S&P 7 is the big technology companies, and they are thriving. They're up for the year. But if you look at the S&P 493, the other 493 companies, they're also flat for the year. So this is a story of certain companies attracting massive cash flows, attracting investor confidence, and even in the big first world markets, there's a difference between certain sectors. Now, when you come to emerging markets, you are right. We in an environment with high interest rates, which is usually not good for emerging market capital flows. And once you see interest rates coming down, specifically in the first world countries, we might see a change in risk appetite and capital flow. But from a JSE point of view, we need to remember a few things. The firstly is that the JSE, if you look at the all share index, it's difficult to say it's a South African market. A major portion of the JSE is dual listed stocks, but even more than that, a major portion is stocks whose business and valuation is not determined in Johannesburg. It's determined on international markets, and Johannesburg is almost a price taker, not the price maker. And I take the big stocks, the Richemonts, the whole process Naspers, the big mining stocks. Joburg is not where the price is made, but is also not where the market is at. Having said that, if you look at the current offering of JSE listed stocks, it is in a precarious position. There's a few elements that shows that. You noted the delisting process where the options of number of listed equities has become less. So therefore, the options of asset managers is less. The options of people structuring portfolios is less. So the options are less. That's the one side of the coin. The other side of the coin is when you have that, you find that the valuations are becoming very inexpensive. And if you just purely look at the price earnings ratio of a proxy, now there's various proxies, but just as a proxy, the JSE is currently at valuations that you usually see when we have big market corrections. So the JSE is priced almost as if South Africa is in a real deep recession, in a problem. It's pricing the risk in, and part of that is because foreign investors have moved away. And the local investors, well, they are diversifying. They're buying the big stocks, and the rest they are investing internationally. So there's a number of factors. The sad part is, as a market, the number of options has become less, and the valuations has become extremely attractive. And one needs to ask: is that for good reason, or is that an opportunity?
You're saying now that the valuations have become inexpensive, and I suppose another way that you can look at that is that the values of the equities right have come under pressure, which in itself will have implication for shareholders who might, at the end of the day, just turn and go, you know what, it's not worth listing at all. So I get the idea that the worse it gets for the JSE, the worse it's going to get.
Look, the point is, Ilse Marie, at some point it offers great value for even for speculators or people buying the stocks, simply because they are inexpensive, and you're paying 50 cents for a rand. Now you can pay 50 cents for a rand forever and a day. The question also around that is, when will that 1 rand be 1 rand? And you can take it even further. When is it 1 rand? But at this point in time, if you look at historic valuations, yes, if it's 50 cents or 70 cents, you're buying at a discount. If you then look at what does that mean, it means a few things. Number one, uh, companies and shareholders whose shares are listed on the JSE at a big discount might look at delisting the stocks. The cost of being listed, the fact that you cannot raise capital, that becomes real concerns. So the attractiveness of a listing becomes less. And part of the companies that are disappearing is because they are delisting. Simply put, they're not seeing value in being publicly listed. So the shares are trading at a discount in terms of valuations, they've taken off. But secondly, the same sign, it does not encourage companies from getting themselves listed on the JSE. So therefore, companies say, but what is the cost benefit worth my while? There's a cost to being listed. And if the aim of the exercise is to have access to capital markets, well, if capital is not interested in being listed on the JSE, then that's not that attractive. So it creates different challenges for different players. Now, the argument that makes it even more difficult is that I'm happy to say that you buy something at 50 cents in the rand. The question is, will I realize my 1 rand? And if it is inexpensive, where the company might get delisted, yes, I'll realize part of that. But the normal way of doing it is that when a market is at a discount, over time the company will show that they're worth more. They will deliver earnings, they will deliver profit margins, and the market will say this is not worth 50 cents, it's actually worth 1 rand. But for that to happen, you need a number of factors, and foremost, you need the underlying stocks, the stocks that's listed, to perform better than what is currently priced in. So priced in is a difficult environment. Will they outperform? That's the question. You can also put that right across to our bond market. Our 10-year bond is currently trading at around 11%. So if you say you can earn 11%, inflation is 5.5, let's say between 5 and 6%, you're getting a massive premium. But are you being compensated for the risk of investing in the South African sovereign? And clearly, there is investors that believe that you need that 3, 4, 5% above inflation to be compensated for it. And that's the same in the equity market. The risk or the discount at which valuations currently is, the market is asking itself, am I being remunerated, or am I being, do I get the return for the risk I'm taking?
Is there something the JSE itself can do? Is its business plan and how it currently operates supportive enough for companies to remain with them?
Look, Ilse Marie, that's a difficult question, because, like any other market, in the end, you're not buying the market; you are buying the stocks in the market. If you go to a vegetable market, you're buying the vegetables. If you're going to a retailer, you're buying the stock that's on the shelf. So the key element is, what is the stock that you can buy. But having said that, the JSE needs to be as efficient and as reliable, as good as any other market, because you can buy the same stock in various markets. You can buy, let's say, Richemont here, or you can buy it in Switzerland if you want to. You can even buy most of our stocks at some of the other exchanges. So the key for the JS is, they needs to be inexpensive, reliable, trustworthy. They need to create all those environments. And what I do think is, I think they're going out of their way to make sure that they actually best of breed what's required. I do think, and that's where I think there is some work to be done on the mid-size and smaller size companies. There's too many companies that, if you talk to management, they question the cost, the the red tape, the rules and regulations. So there's always work to be done in that respect. But in the end, if you are not an efficient market, you won't get the participants. If you're an efficient market and you run the best in the world, it still depends on what is the stocks that's listed. You want to buy into companies. You want to buy into the underlying company. Yes, you need to do it efficiently. It needs to be smooth. It needs to be reliable. Great, but you still buy the company. And if the stock on your shelves are not what investors want, you can do whatever. You can stand on your head. You're not going to get it right.
So, how do we get it right? Do we wait for the global recession to hit and then we kind of move through the motion and the risk off sentiment comes back into the markets? Will the money flow back? You know, in what scenario will these billions flow back?
Never forget markets work in cycles. And if the market is at the most optimistic, it's the most expensive. And if the market is the most pessimistic, that's usually when you pay 50 cents for a rand. So there's a reason why markets are inexpensive, why markets are cheap. It's because the sentiment is against investing, buying South African stock. The sentiment is difficult to predict where it's going. And you have to remember that capital is a coward. Capital doesn't like risk. Capital doesn't like uncertainty. Capital is skittish. Capital will run away. Capital will find greener fields. Capital will find reasons not to be there. So you have to overcome that risk, that skittishness, by giving certainty as to what type of return I can do. And if I cannot predict with enough confidence what the underlying economy will do, not necessarily the underlying economy, what the company will do. If I don't have the confidence to be able to project future cash flows from dividends, if I don't have the confidence to predict earnings, if I don't have that clarity, if that is a clouded picture, I'm going to run away. I'm going to allocate my capital elsewhere because capital is a coward. It's skittish. It's going to run away. So therefore, you need to have a kind of a line of sight of earnings going forward, of the underlying economy going forward, and then you can calculate: am I being compensated for the risk I'm taking? And if I'm not being compensated, well, I'll allocate my capital elsewhere. If I believe I'm compensated for the risk, I will allocate my capital. So it's a big question about where do I believe I'll get the optimum risk return profile. And at this point in time, the fact that we are inexpensive means that there's capital believes the risk return profile is not in place. So two things can happen. Either the yield even gets higher, so therefore I will require a higher dividend yield or a higher earnings yield or a lower price earnings ratio. I expect something more before I take the risk. Or I change my risk parameter and say, wait a second, I believe some of these risks are being addressed. I've got clarity of earnings. The pricing is correct. I'll allocate capital. And at this point in time, what the world is telling us, both on the government bond side trading at 11%, they need a very high return to compensate for the risk. Same as equities. They need a high risk premium to allocate capital. And either something needs to change before that happens. But remember, these things are in cycles. It's cycles come and go. In hindsight, it was always easy to say where the great buying opportunity was. In hindsight, it's easy to say when you should have sold. The point is, we are now at the area where you're paying 50 cents for a rand, and you got to question why, and or is it perhaps not a rand? Is it only worth 50 cents? Just take the commodity shares the last, let's say, since the beginning of the year. Some of the big commodity stocks lost 50, 60%. They gained 10, 20% in 2 or 3 weeks. The point is, it's difficult to gauge. And that's where our market is. With uncertainty, people take a flight, they run away, they're not there.
And there's sufficient news on the ground right now to spook capital behoorlik in die berge in. So hopefully the cycle turns, and we look forward to the cycle turning, and they can come back out of the hills.
Oh, yeah,
So we'll see.
you want that big kudu to there's a reason why the kudu's got the big horns. It can calculate risk return. Otherwise, it wouldn't be there. And the same with capital.
Exactly.
Capital calculates risk return. Calculation doesn't work. It's running away and you're not going to see it.
Theo, thank you very much for joining me. I really appreciate it. I'm sure we'll chat again, and let's hope the cycle turns quickly for South African stock market.
Thank you, Ilse Marie. It was a pleasure.